What if one tweet triggered the most dangerous $44 billion gamble in tech history? Elon Musk risked billions, his reputation, and maybe even his entire empire. One deal. $44 billion. And a gamble that could change the internet forever.
The provocation. In early 2022, with a net worth near its peak, Elon Musk begins quietly acquiring Twitter shares, disagreeing with its moderation policies and its role as a public square. The passive stake. By April, Musk has amassed a 9.2% stake, becoming Twitter's largest shareholder. He is initially offered a board seat, but declines, preserving his freedom to act. The bang offer. On April 14, in a bold, unsolicited move, Musk makes a best and final offer to buy the entire company for $54.20 per share, $44 billion, calling it his final bid to unlock Twitter's potential. The poison pill. Twitter's board, wary of Musk's erratic style, unanimously adopts a poison pill defense to dilute shares and thwart a hostile takeover. The financing puzzle. Musk stuns markets by securing commitment letters for $46.5 billion in financing within days, $13 billion in loans against Tesla stock, $12.5 billion in margin loans from banks, and $21 billion in cash from himself and equity partners. The deal turns. Facing a legally robust board and binding debt commitments, Twitter reverses course and accepts Musk's offer on April 25. The world watches in disbelief. Buyer's remorse sets in. As markets tumble, Musk begins publicly questioning Twitter's bot count, claiming he was misled. He puts the deal on hold, triggering legal chaos. The courtroom ultimatum. Twitter sues in Delaware Chancery Court to force Musk to complete the deal. A trial is set for October, with most analysts predicting Musk would lose. The reversal. Again facing a damaging deposition and a high likelihood of legal defeat, Musk performs a sudden U-turn in October 2022 and agrees to buy Twitter at the original price. The overpay. The deal closes on October 27. Musk has bought Twitter for $44 billion, a price many analysts deem 30 to 40% above its fair value at the time, cementing the overpaid narrative. The debt burden. The company is saddled with $13 billion in new, high-interest debt, creating an annual interest burden of over $1.2 billion, dwarfing its previous earnings. The radical overhaul. Musk acts as a thermonuclear CEO, firing top executives, dissolving the board, and laying off roughly 80% of the staff in a drastic cost-cutting crusade. The ad exodus. Rapid, chaotic policy changes, like rushed verification changes, and controversial content reinstatements spook major advertisers. Revenue plummets by over 50%. The cash flow crisis. The perfect storm hits, crushing debt payments plus collapsed advertising revenue plus massive severance costs. The company bleeds cash, reportedly at a rate of billions per year. The Tesla shadow. To fund the deal and excess losses, Musk sells billions worth of Tesla stock, contributing to a steep decline in its value and worrying Tesla investors. The desperate pivot. Musk pivots X toward a subscription, X Premium, and payments model, betting on a everything app, X vision, but user adoption remains minimal. The valuation implosion. By 2024, internal valuations and secondary market sales suggest X is worth less than half of what Musk paid, roughly $15 to $19 billion. The personal leverage. The core danger is laid bare. Musk personally guaranteed a portion of the loans. The financial failure of X could force a fire sale of his Tesla or SpaceX shares. The domino effect. The bet threatens his entire empire. Leveraged shares, margin loans, and cross-collateralization mean trouble at X could destabilize his leadership at his core, world-changing companies. The unresolved end, the story continues. Musk bets everything on the long-term X vision. The question remains, is this a catastrophic misstep, or a painful but calculated transition to a future powerhouse? The debt clock is still ticking,